Are you wishing that you could still get a 2.5% mortgage? Well, you can. Just assume one. When you want to buy a house, you'd ordinarily choose a lender and apply for a brand new mortgage. But in a case where the house you're buying has an assumable mortgage, you can acquire the house by taking over or assuming that existing mortgage. In these cases, you take on the seller's remaining mortgage balance. This means the remaining balance, the mortgage interest rate, the repayment period, and other loan terms stay the same, but the responsibility for the debt is transferred to the buyer. When mortgage rates rise, there are always homeowners who are at risk of being priced out of the real estate market. Right now, mortgage rates are the highest they've been since 2001. A tough situation for many people dreaming of home ownership. Loan assumption can be a powerful tool for you as you shop for houses because it could allow you to pay lower interest rates even as the housing market becomes more expensive. So how does it work? Mortgage assumption allows the buyer to take over the original loan balance at the original terms. But it's important to note that it doesn't account for the equity. If the house has gained value since the original loan was issued, the buyer will need to cover the difference known as home equity with cash or another mortgage. For example, if the seller has a $100,000 loan balance on a $200,000 home, the buyer will need to bring $100,000 to be able to compensate the seller for the equity they've built. A home equity loan is a common second mortgage option for buyers who are assuming mortgages and don't want to or can't put down cash to cover the equity. Although the second mortgage will likely have a higher interest rate than the assumed mortgage, the principal amount will be lower than what's needed for the first mortgage. You may also hear the term novation used instead of assumption. Simply put, novation means the mortgage lender participates in and agrees to the full transfer of liability from the seller to the buyer. Because the lender is able to put the buyer through the underwriting process, it is willing to release the seller from all future responsibilities of mortgage payments. So, which loans are allowed to be assumed? Well, generally it's government-backed loans, Federal Housing Administration or FHA loans, U.S. Department of Veterans Affairs or VA loans, and U.S. Department of Agriculture, USDA loans are all assumable. And conventional loans can be assumable, but only in special cases. For FHA loans, some of these are assumable, but only as long as the lender approves the sum. All VA loans are assumable, but with additional rules and qualification requirements that govern exactly how. Because VA loans are provided by the U.S. Department of Veterans Affairs, borrowers will normally have to be active duty service members, veterans, or eligible surviving spouses to qualify for a VA loan. Not in the case of an assumption, however. The person assuming the loan isn't required to be affiliated with the military, but they have to use the home as their primary residence. They have to qualify with the existing lender, and they have to pay a 0.5 percentage point to the Veterans Administration. There are really two different ways for a USDA loan assumption to occur. The first is with new rates and terms. Most USDA loans are assumable in this manner, which transfers the responsibility for the mortgage debt to the buyer, but also adjusts the debt by re-amortizing it with new rates and terms. The second way is with the same rates and terms. It's available only in special circumstances. This type of assumption is usually reserved for family members who are exchanging the title of a property. In these cases, the rates and terms of the original mortgage are preserved and no review of the buyer's creditworthiness or appraisal of the property is required. Well, can conventional loans be assumed? The answer is sometimes. In most cases, they aren't assumable because the mortgage contract contains a due-on-sale clause. This allows the lender to demand that you pay the entire remaining loan balance as soon as the property is sold. However, if you have a conventional adjustable rate mortgage and meet certain financial qualifications, it's possible that your mortgage is eligible for assumption. Fannie Mae, one of the two mortgage agencies that sets rules for conventional loans, allows assumable loans on ARMs as long as the borrower doesn't exercise any option they may have to convert the loan to a fixed rate mortgage. So, what are the pros and cons of assuming a mortgage? The pros are low interest rates, fewer closing costs, no appraisal, and less debt. And the cons? A higher down payment, sometimes credit and income requirements, and a note for VA borrowers. If you sell a house with a VA-backed mortgage, through assumption, your VA loan entitlement won't be available until the assumed loan is paid off, unless the buyer is a qualifying veteran with an entitlement. That's a brief overview of loan assumptions. If you have any questions, please don't hesitate to reach out.
Thank you very much.